Hi, everybody. Scott Riley with the Market Update Desk. February 28th, we're coming off yesterday's spectacular 73, 74-degree day. And now we're looking outside, getting what is supposed to be forecasted as snow showers. Only in Michigan do we get all four seasons in 24 hours. Yep, Michigan weather is nothing if not unpredictable. Today, we've got the first thing that came out was the second look of Q4 GDP. That showed that the U.S. grew at a rate of 3.2% compared to what was previously reported on the first look of 3.3%. Now, this slight reduction in what the GDP reading was did help the bond market out this morning, which is always a fantastic thing for mortgage rates. We do think that when the final look of Q4 GDP comes out in approximately a month, it's actually going to be a little bit less than that 3.2%, because we think it's contracted a little bit more than what the market has forecasted and even the Fed had forecasted. Tomorrow, we have the all-important PCE reading, personal consumption expenditure. This, as the Fed tells us, is their favorite measure of inflation. The market is expecting headline inflation to rise between 0.3 and 0.4 for month over month, and decline for the year to somewhere between 2.4% and 2.3%. And that would be down from where we are right now of 2.6%. So while we may go up a little bit hotter than expected month over month, the year over year is going to fall. Now, the core rate is expected to rise between 0.3 and 0.4 for the month, and the year over year to decline to about 2.8 or 2.7%. Now, that would be from 2.9% where we sit right now. Even if we don't get as favorable of a PCE reading as the market is hoping for, we already saw the bond prices sell off in response, keep in mind, to the CPI and PPI reports. So much of the downward move could be priced in already. Additionally, if we do get a surprise cooler than expected number, could definitely get some outsized returns and some positive movement in the bond market and mortgage-backed securities. So it is going to be a very important reading tomorrow, what we get. The Atlanta Fed wage tracker. Now, this is interesting as it relates to wages. Wages in January moderated from 5.4% to 4.7%, which is a significant deceleration. The average would have been actually even higher if not for government wages increasing 6.7% year over year. So as we see, the private sector is seeing some slowdown in wage pressure, but the government payroll wage pressure is still there, and it's pushing it up, probably more than what it should be. And the wage pressure is one of those big things that the Fed looks for when it talks about monetary policy, when to cut rates, how much to cut them, or when to raise them. Fed comments that came out yesterday. It seems like every day we get Fed comments, by the way. Fed Governor Bowman spoke yesterday and acknowledged that PCE inflation is below 3%, but mentioned that the recent CPI and PPI inflation readings were hotter than anticipated, and believes that Fed policy is appropriately restrictive right now and is not ready to cut. Thanks, Fed member Bowman. That's not a surprise. Been very hawkish on their comments and on and what they indicate out there in the market. Now, we do have a new Kansas City Fed President Schmidt, who will vote not this year but next year, said he is in no rush to cut rates and is not a big fan of slowing the reduction of the balance sheet. Now, that's a big deal when he's talking about the balance sheet, because that is something the market is expecting to see some runoff of the balance sheet to get that back in proportion and where it probably should be. Now, this is all based on what the Fed keeps talking about as positive expanding job numbers. But as we know, what we've talked about is those BLS jobs numbers are so seasonally adjusted and imputed that they don't make sense compared to the reality when we look at private payrolls. So if we start to see unemployment go above 4.2% in the coming months, we could definitely start to see the Fed change course with some velocity with talking about rate cuts and how many rate cuts. So things we definitely want to look for. Mortgage applications for purchases last month fell 5%, and last week, and refinances fell 7% last week. So we've got those things going on. We're anxiously waiting how the market gets through today, which will probably be pretty flat in all reality. We do think a lot of the inflation numbers have already taken the hit in bonds and mortgage-backed securities. Even if we get a hotter than expected number tomorrow on PCE, I don't think we're going to get the proportion of hit in the market as what we normally would, because a lot of that's already cascaded through from CPI and PPI. So let's see how we get through the end of today and tomorrow, and hopefully get a little bit better expected numbers and propel us forward to help our buyers out. So the Market Update Desk is here. We're the singular original source of market moving news every day in the West Michigan area. We thank you for watching. Go ahead and give us some likes and shares. Follow us on all of the mediums, Facebook, Instagram, and YouTube under the Market Update Desk. We're here to help you out. Give us a call with any questions. 616-293-2189. Hope you have a great day.